Traders. Welcome to this edition of Expert Market Analysis brought to you by Errante. Whilst I just let you have a couple of look at our new slides and just describing who Errante are and our best characteristics, I also need to show you the disclaimer, so I just get you to look at that. I'll just run through some of the key objectives of this webinar. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term or short-term themes or fundamentals that increase or decrease in importance over time. So I also need to just show you this general disclaimer before then we crack on with the webinar. Should take 20 to 30 minutes or so. We try and condense it now just to get all the main themes and what we're looking at, as well as reviewing the key risk events that have been happening in markets. Okay, today's topics, we'll just check out how markets are trading currently. We'll look at the theme, of course, which has been hitting and impacting markets for some time now, of course, tariffs and trade policies out of the US. We'll just briefly also, just run through a few thoughts on that. We'll look at investment banks, actually, some of the Wall Street banks who have revised their S&P 500 year-end targets as well. So we'll just check that out. Before then, having a quick look at the last week's two main central bank meetings, just of interest around tariffs, again, all relating generally to that. We'll look at Tesla's earnings, which are out yesterday, overnight after the US close, essentially. Before then, previewing the PMI data out of the US, and we've also had that PMI data out of the Eurozone and UK actually as well. So we'll just run our eye over that, which is, I put in the preview, but is obviously happened already in the UK and Eurozone. So we'll just check that out, as well as Google's earnings, which are out after the close, US close that is, on Thursday. Okay, yes, currently at the moment we've had, well, more flip-flopping really from President Trump regarding his latest thoughts on essentially sacking Fed Chair Powell and also a trade deal with China. And he sort of offered a slightly softer stance really in his recent rhetoric, at least, towards Beijing. I'll just pull up a few charts. First of all, this is the major FX performance of the currencies versus the dollar. Of course, you can just see how we have been acting through this month, through the last few weeks. So we have had a softening in Trump when answering questions, press questions, really late last night after the US close. So markets have taken heed of that, really a lifeline, a rescue line from Trump. And before him, actually, we had Treasury Secretary Scott Bessent, who said that the current tariff situation with China was unsustainable, and he expects a de-escalation in the near term with Beijing. So that all helped risk-taking, has helped risk-taking overnight and today, certainly also helping the dollar. Volatility has come down now and is below 30 now in the VIX, and that is on really sort of this softening, as I say, of the stance with China and the US. And there has been a little bit more focus on corporate earnings as well as this PMI data. The dollar has rebounded, although is suffering a little bit today. But this Trump rhetorical shift on tariffs and the Fed interference is positive, of course, or more positive, slightly more positive for US assets. Equities, as I say, gaining on trade optimism, really. Powell staying. We've had Tesla results and the stock is up over 5%, I think, in the pre-market. We had 3M rise as well. And then in fixed income, just checking that out, US Treasury yields, 10-year yield is just a touch lower, 2-year yield lower as well on that Trump change of tone. Whether that holds or not is the key question. And we're seeing gold actually slump again today after yesterday's quite abrupt fall after posting another record high at $3,500. Really on again Trump's easing of tensions. Yeah, so a slight turnaround in gold. I'm just checking out Asian markets, and generally they've broadly risen. Stock markets following Wall Street's strong overnight performance, and that was before these optimistic signals from President Trump on reducing tariffs against China. The Hang Seng, that jumped nearly 2.5%, reaching a near 3-week high, driven by tech and consumer stocks. The Nikkei, the Japanese Nikkei, surged over 2%, again bolstered by those easing trade tensions and actually strong private sector growth in some of the PMI data. Mainland China, the indices was relatively flat, really reflecting caution still amid certainly ongoing uncertainties around bilateral trade negotiations, of course. If we just pull up, yeah, this is now FX performance, just looking, we'll come back to equities shortly, but just generally FX performance, you can just see still safe haven yens have pulled back slightly from last time, 8.6%. That was just month to date. Swiss outperformance against the dollar, 5.3 the yen and 5.2 the euro. Now sort of similar, but the Swiss yen sort of slightly pulled back of sorts. If we just move on to yeah, what I wanted to talk about, well, US equities, first of all, they rallied sharply, as I said, on Scott Bessent's reassurance. That was ahead of what then Trump said. The Dow surged 2.7%, S&P gained 2.5%, Nasdaq 2.7%. I'll mention Tesla in a minute and go through those results shortly. 3M though, that soared over 8% after reaffirming guidance, but then we did have some industrial stocks like Northrop Grumman down nearly 13%, Raytheon or RTX that is now known down nearly 10%, really plunging on tariff impacts. Futures are up though, as I said, still again in the main stock indices on those supported comments from Trump. I just want to get to this, which is a chart showing you some of the investment banks, major investment banks, and their reappraisal really of their forecasts that you can see on the chart there. So the red line is their year-end target for the S&P 500 in mid-January, and then the blue is now their most recent forecast for the S&P by the end of the year. And you can just see they moved from, I think, an average of above 6,500 by year end, now down to just above 6,000 as an average, that is, for year-end targets by major investment banks for the S&P 500 by the end of this year. So just above 6,000, that would be a move of around 12% or so, roughly, from where we are at the moment, just a bit less probably now. So still a big move, but only around 2% higher than last year's close. And of course, on the back of those 20% plus rises that we have seen or did see in 2023 and 2024. So just for your guide, yeah, just investment banks moving their year-end targets. Essentially, of course, if that does happen, then it could become the first bear market specifically triggered by the US presidential actions when lower taxes, of course, lighter regulations were meant to fuel more gains. Of course, since the Liberation Day shock at the start of this month, yeah, we've had obviously major volatility, even though we are bouncing, of course, from that spike low from Monday the 7th. Of course, combined with that, valuations have been rich, positioning was crowded, and of course, leadership was particularly narrow as well. So all combining to for volatility, and then these the reassessments of year-end targets by some of the Wall Street banks. In amongst that, I just want to look at the gold chart as well. And if you bear with me 1 second, I'll just pull up that chart, which is here. So you can just see, we'll go to the weekly chart. You can just see this really nice ascending bull channel. So series of higher highs, higher lows, breakout of a sort of wedge pattern, continuation pattern, really bullish continuation pattern. And then we've had this sort of slightly sort of ascending wedge, which would normally mean a breakdown, but what we've seen is then a continuation, and we've moved out of that bull channel now and sort of gone much with steeper rise essentially, and really interesting candle on the week there. You can see potentially that's quite a strong negative reaction to higher prices. We did print just above 3,500, 3,500, just above that yesterday, but then we've pulled back over the last, well, yesterday and today, now down around 5%, over 5% in the last couple of days now. So interesting point really for gold, very extended, as you can see on that weekly RSI above 80 still. On the monthly, I think the RSI was the highest in 20 years, I think, on that monthly gold RSI, so momentum indication. So really pointing to potentially a pullback. A correction would not be unexpected, of course, with this sort of huge move higher. We were over 30% up year to date in gold, and all because of pretty obvious reasons. Safe haven characteristics of gold. We've had central bank buying continue. ETF holdings are the highest they've been since September 2023, and of course we've had Fed rate cuts as well get priced in, with around nearly 25 basis point cuts for this year. So that all helps gold, and of course the falling dollar really makes gold cheaper for other currencies as well. So various factors really driving gold to these price rises, but interesting now just to pull back that we are seeing now down to 33.26. The nearest fib level we've got for this move from the lows in October 23 is at 3,100, just above that. But certainly the top of this Keltner channel that we use, that's at 32.47. So whether we get some support around that, or whether we have to move a touch lower now and just ease these very overbought conditions, that will be interesting for gold moving forward. Okay, let's now just get back to our slides. And next up is a quick review of the ECB meeting and the Bank of Canada meeting, as well as Tesla earnings. So if we first go to the ECB, just briefly, before then we look at the Eurodollar chart as well. Yeah, last Thursday we saw another cut by the ECB of 25 basis points, bringing the depo rate to 2.25%. That was its 7th reduction since June last year. That came as little surprise, really, with the latest developments, escalating trade tensions, of course, unprecedented policy uncertainty, and obviously as well the strengthening of the euro exchange rate. The meaningfully less restrictive monetary policy stance phrase that was dropped and not replaced. And of course, then US tariffs and the never-ending really back and forth at the moment uncertainty have brought really growth concerns for the Eurozone into focus again, clearly offsetting that previous optimism that we had seen stemming from the German fiscal policy U-turn, at least in the near term. Strengthening of the euro with the trade-weighted exchange rate at a record high, plus the drop in energy prices, have also added to the disinflationary impact that the current trade tensions will have on the Eurozone. If you think about it, inflation is meant to rise in the US, whereas if products don't go to the US, then they go to other parts of the world like the Eurozone, which means prices should get cheaper, and we see a disinflation trend potentially developing. Just during her press conference, then President Lagarde, she stressed the downside risk to the Eurozone growth outlook had increased, and that there was now more uncertainty about the inflation outlook as well. Interestingly, there was a debate about a 50 basis point cut, but really given the high level of uncertainty, even just a few weeks ago, some members of the Governing Council were in favour of pause, then certainly a 50 basis point cut was a bit too big of an ask. But going forward, the risk is for probably actually the ECB undershooting of its inflation target if trade tensions do not fade away. And you can just see this chart here. We've got the core Eurozone inflation figure in the blue, then the red is the headline, and just see how we've fallen, of course, sharply, and now just sort of picked up, but now just turning around again, potentially going lower with tariffs if this comes to pass, of course. This inflation trend potentially then means more rate cuts by the Fed, by the ECB, apologies. I think Lagarde used the words readiness and agility, really, and that does tell markets that the bank's sense of urgency has increased quite clearly for more rate cuts going forward, potentially. If we just look at the euro-dollar chart then. Which is here. You can just see then just a turnaround really after posting highs above 115, 115.72, that high, but a spike high on the weekly. You can see the next fib level we've got of this move from the high in January 21, actually back to January 21 down to September 22 low. Well, yeah, next upside level is 117.47, and then we've got the 61.8 of that move at 112.74. That capped the upside in July 23 and really in August and September of 24. So interesting whether that keeps should be pretty strong level of support there, 112.74. And then you have got that long-term trend line. It's a monthly trend line actually from the 08 high actually, and you can just see how we burst through that, have burst through that this month, and that'll be interesting whether we keep above that line, which comes in around those highs from August of this year, which are up around 112.14. So a few levels there in euro-dollar to watch out for, especially with this move now that we're just turning around, even though we've had some buyers step in, you can see, and pair those losses from earlier in the session today. Let's look at briefly dollar CAD as well now. After the Bank of Canada, they left their policy rate unchanged at 2.75% last week. It's actually the first pause since it embarked on its easing cycle in June 24. Central Bank offered no guidance really for future policy. That has happened over the last few months, and only that it will proceed carefully. They kind of consider two scenarios. So the first one means uncertainty is high, tariffs are limited in scope, and Canadian growth weakens temporarily, with inflation currently around 2.3%, remaining around that 2% target. But the second scenario is really a protracted trade war causing a recession this year, and inflation rises temporarily above 3% in the middle of next year before returning to target. So interesting couple of scenarios there. As well, there was around a 40% chance of a rate cut at this meeting priced into markets. So it did trigger a little bit of CAD appreciation after that status quo decision really. But money markets really still expect around just less than two additional rate cuts for this year going forward. For dollar CAD then you can see you can see that candle that I've just pointed to here is that appreciation, so dollar CAD going lower. And since we've moved down through the black line, which is a 200-day moving average at 140, just above there, then we're drifting lower now. We've got a recent low at 137.80, and then if we just pull this back, we've got a fib level around 137.13. That'll be the target for Canadian dollar bulls, dollar CAD bears, if you like, and then we've got resistance at 139.44. Okay, also, I said we'd look at Tesla's earnings, so I'll just pull up this chart. Obviously, key stock for everyone to look at, really interesting, because part of the Magnificent Seven, and it's been troubled, of course, with its CEO Elon Musk and the brand damage it has suffered. Those earnings came out late last night after the US close, actually reported its worst earnings since 2020. Net income, just looking at the numbers, collapsed by 71% to just $409 million from $1.39 billion previously. Revenues, they slid 9% to 19.3 billion. That was short of analyst forecast of 21.3 billion. EPS as well, short, 27 cents versus 41 cents expected, and gross margins sank 12.5%. That's the lowest in a decade. A lot of negatives, and that has been priced into the stock price, of course. A bright spot was free cash flow. That surged to $664 million, so well above estimates. Yet really the market reaction since, and in the grey market, as I say, stocks up around 5-6% or so, has not been about the grim numbers. As I said, a lot is in the price, with that brand damage, with increasing competition, and with production disruptions, plus of course tariffs. But investors kind of cheering Elon Musk's promise basically to dramatically scale back his controversial political engagements, while also actually offering no firm guidance for 2025, apart from plans for a more affordable model by the end of the first half of this year. Certainly tariffs came up, global uncertainties came up, and that was a reason for no firm guidance for this year. But certainly key going forward for the stock obviously will be, well, Musk's commitment to becoming more engaged with Tesla. The product refresh will be key, and that more affordable model for sure. And then also potentially the robo-taxi rollout. Potentially there is a June Austin pilot launch, which will be key. And then in amongst that, of course, we still have tariff risks, potentially supply chain disruptions, and then also this brand recovery. So yeah, a lot going on with Tesla. Really interesting that yeah, we had very strong support around this figure, around 213 or so, which was a fib level, minor fib level that you can see from the low in April 24 up to that record high in mid-December at 488, that record high. We've tumbled since then down to 237, but potentially with this gap higher today, then we could see prices above 250 by all accounts if we get a sort of 6% move or so. That would take us to the middle of this Keltner band, so interesting, or just below that. So still in this long-term downtrend. In fact, quite a nice trend line here as well, which we should put in, which just taps the closes really, which is what we're interested in. So whether we can get back above this long-term downtrend line or not with this gap higher, that will be interesting. Then bulls potentially focusing on, well, the 50-day moving average at 275, and then that 61.8 level at 272 as well. Interesting, the 50-day has crossed below the 200-day moving average, 200-day at 291. That means a death cross potentially, and there's a bearish signal though. Yeah, there is conjecture about how much or how valid that signal is. Okay, that's Tesla. Let's move on briefly to the PMI data. So if I just pull up a nice graphic, just bear with me 1 second. Yeah, if we just move on now to, well, the PMIs, preview, review, and Google earnings. First of all, the PMIs. This is a really nice matrix from Reuters, actually, just showing you Blue being in expansion territory, red being in contraction territory, so below 50 or above 50. And you can just see how especially Eurozone has been in the red and just moved out of that until really well, today we had some interesting numbers really, judging from the headline number, and it was really all about Trump's tariff announcements, of course, and chaos as well, how much that would impact these business surveys. Remember that these tell us whether things are getting better or worse and not by how much. Really at big turning points, the tendency is for the data to kind of exaggerate shifts in economic activity. So for the Eurozone, we had numbers which, yeah, judging from the headline, at least damage doesn't look too bad, but there is some detail in that as well. Manufacturing rose actually to 48.7 from 48.6 and above the expected 47.1. Services, though, declined to 49.7, so below 50, below the expected 50.3 and from the previous 51.0, and that all left the composite at 50.1, so just above 50 versus the expected 50.3 and the previous 50.9. That said, forward-looking components, which are important, they point to a further weakening of economic activity. And also then to add to the picture, the composite PMIs for France and Germany actually weakened as well in April, with both countries now below that 50 threshold, really on course for yet another quarter of contraction. And their weaker sentiment was not only driven by manufacturing, but also by services. Interestingly, though, price pressures eased further in April, and that is a key look for markets, really, for central banks as well. It kind of justifies the ECB rate cut from last week. And in fact, with low price pressures and weakening economic activity, again, it backs up that idea that we'll see more rate cuts by the ECB going forward. Of course, what firms say about input and output prices really will give us a hint of where prices go going forward amid, of course, all the moving parts unleashed by, of course, tariffs and policy uncertainty. Rate cut for the next meeting in June for the ECB looks pretty certain at the moment, above 70% chance of that, I think, and even higher now. Really, policymakers, as I've mentioned, focusing on the negative growth shock from the trade war. So that's the Eurozone PMIs. For the US, normally the ISM data is more important, but PMIs have taken on some importance as well. Obviously, this is all around tariff news and headlines. But interesting, again, the price index will be a focus for markets because they will point potentially to the inflationary impact of tariffs. And in the US, it actually has already signaled the fastest rate of input price rises in nearly 2 years. So just watch out for that in a couple of hours' time from the US and that PMI prices data. The UK, just quickly, if we just pause this, we'll just pull up a cable chart actually. So bear with me 1 second. So cable chart is here. UK PMIs, though, they were pretty much lower than expected. The services PMI data that printed below 50 at 48.9 versus 51.5 expected, 52.5 prior. Manufacturing in line actually 44.0, but down from the prior 44.9. That all meant the composite ticked below 50 to 48.2 versus 50.4 expected and 51.5 prior. So that composite is actually now at a 29-month low in the UK. Services 27-month low, manufacturing 32-month low. That's the output index, and the PMI at a 20-month low. So yeah, not great numbers out of the UK. The collapsing confidence, dropping outputs during April does really raise red flags as to the near-term economic outlook, really. Adds pressure really onto the Bank of England to reduce rates again at its May meeting. There will be some uncertainty, though, as to whether the recent upturn in price pressures could become entrenched, really, or whether it merely represents a short-term tax-related spike, which should be looked through. That was actually comments from the chief economist at S&P Global who put out that data. So yeah, interesting numbers, not great, but sterling doing relatively well, pairing those losses that we saw earlier in the session. You can just see again, hopefully it's not too confusing with these Keltner channels. We've just eased those overbought conditions now, having got up to very close to that high from last autumn at 134.34. We got to 132.21 and 23. So that is a major level of resistance now, zone of resistance, if you like. So it'll be interesting whether we can just consolidate around these levels before then having a look again at above 134. Nice bull channel, really. And we're just sort of in that ascending channel, as you can see from those lows from middle of January. Okay. I think I'll wrap it up there. A nice short, well, 30 minutes or so decent time. Hopefully that's proved of use to you guys. Really do appreciate you being on the call. And yeah, don't see any questions either. So please do tune in a couple of weeks' time when we'll be back to you at the same time. Take care, and we'll speak to you soon.